Okay, I'm going to work out P2-12. This is the problem here. And we were recommended to start with part 2 of this problem because some of these accounts go into the income statement, like insurance expense and rent expense. And so it's important to find out the balances for these accounts. So that's what I'm going to do, is start with number 2. So the first one we'll do is prepaid insurance. And I like to set up a T account for this. So let me write this out. So the T account will be the beginning and ending balance of prepaid insurance if it's given. But as you can see, we're only given $2,500 for the beginning balance of prepaid insurance. So we're going to have to work to solve for the ending balance, which is the goal of part 2. At the beginning of the page, we're given that... Sorry, one second. My thing's messed up. Oh yeah, it's scooted the problem. Okay, there. So at the beginning of the problem, we're given that cash paid for insurance was $6,000 for the whole year. But in the additional information, we're told that the insurance was paid April 30th. So the payment will increase prepaid insurance, and this was done on April 30th. However, we had insurance expense incurred before April. We had insurance expense incurred January through April. And so we're not given how much that is, but we make the assumption that they use up all the prepaid insurance before the new insurance payment kicks in. So that's why I credit it for $2,500. And then we have to calculate how much insurance expense there will be from April through December. So to do this, you take the $6,000 divided by 12. And you multiply by how many months. So it's 8 months. Technically, this isn't April, actually. This would be May 1st. So times 8 months gives you the rate of $4,000 that was used up during the year. So then this is everything we need to get the ending balance. So you can add all the debits and then subtract the credits, which is what I usually do. Or else you can go in order of when the transactions occurred. So the ending balance for prepaid insurance will be $2,000. And on this side of the equation here, these two things represent insurance expense incurred for the year. Basically, the entries would be, so let me do the entries too. On April 30th, we'll make an entry for using up the insurance. So that will be insurance expense, and I'm just going to abbreviate it. Insurance expense of $2,500, and then we don't credit cash for this since it's prepaid. We credit the prepaid account. And then also, they did do the cash payment on April 30th, so we debit prepaid and credit cash. And this is just prepaid insurance, but sometimes I shorthand stuff just for the sake of time. So for $6,000. So that's why we debit it. Basically, a T account is just a shorthand way of doing the journal entry, sort of. And then I'm going to draw a box around that. And then at the end of the year, so I'll put 12/31, the entry you have to do an adjusting entry. So what this is the adjusting entry, which adjusting entries never impact cash. So we recognize insurance expense and we decrease the prepaid for that amount, which we calculated as 4,000. Basically doing the same thing, like taking the 6,000 divided by 12, then multiplying by the number of months. So that is basically the journal entry summary of how we got prepaid insurance. You can do journal entries or T accounts. I like doing sort of both if I'm really stuck on a problem. And then let's move on to part B. Part B is going to be prepaid rent. So if we go up here, we're given that prepaid rent is 11,000 as the beginning balance. So basically, I used the same thought process as I did in part A, where this represents, like, they don't make the prepaid rent, don't make the prepaid rent payment until June 30th. And so I assumed that this 11,000 is used up during the year, because they have to have had incurred rent expense like throughout the year. So even though the problem doesn't explicitly say it, I think it's an assumption you're supposed to make. So then this would represent a rent expense from January through the end of June. So then we have to calculate how much will be from July through December. And you have to go back up to the cash disbursements for this too. And annual rent payment is 24,000. So that is debited because it's increasing our prepaid rent account. And then we have to come up with the amount that will be used for the monthly thing. So there are multiple ways to do this. I usually do 24,000 and then I get it in a monthly rate. And I multiply by the number of months, which will be 6. There's like probably easier ways, like some people prefer doing a fraction like 6/12, but I just like getting the monthly rate. So that's 12,000. So then that represents the expense we incurred from July through December. And the journal entries will sort of be the same, and I'm probably not going to write them out for time's sake. But if you have any questions, you can always reach out and I can do the journal entries for you. Basically, this will represent, like, you'll debit prepaid and credit cash for that amount. And then this is like rent expense, prepaid. And then it's basically the same entries as up here, just with rent and like these amounts. So then part C is interest receivable. This one for some reason was the most confusing when I initially worked out this problem, but it's not as bad like as I've gotten through it and understand it more. But it's definitely, to me, the hardest one. But some people have different strengths and weaknesses, so maybe it makes sense a lot to someone else. But at first, I was thrown for a loop for this one. So interest receivable is going to be 3,000. Sorry, that was a sloppy line. But yeah, 3,000 as the beginning balance. Oops. So also, like, you have to know what if you do a T account, you have to know what ones like increases debit and decreases credit. And so I use the mnemonic like dealer, which is dividends, expenses, and assets. And then there's liabilities, which I'm just shorthanding, owner's equity, or shareholders' equity, or just equity. Like, people call it a lot of different things. And then retained earnings. I don't know if he's gone over this in class, but basically this mnemonic some people use to try to help when they're learning debits and credits. Like, these normally have a debit balance unless they're a contra account, and then these normally have a credit balance. I used this mnemonic a lot when I was first learning, and now it's second nature. So let's go back to interest receivable though. So we're given the beginning balance of $3,000, and then this is related to the additional information number 1 because it's a receivable. So they lent the customer money and they're getting interest, and then they'll eventually get the principal. However, like, the principal is not due until 2027, so we're not doing anything with that. We're solely focused on interest, and interest is usually an adjusting entry. We're told that they lent the customer $50,000, and interest is payable annually on March 31st. So basically this problem, like, the amount of interest revenue they're going to incur for the whole year is going to be January through December, but they also, like, they also get the payment March 31st. So you can split this into 2 entries, or you could just do 5,000 times 8%, and that gives you, like, total interest revenue for the year. But if you break it up, you just have to make sure you do... I like to break it up just to think about, like, the way the cash is flowing too. But if you break it up, you'd basically do the 50,000 times 8% divided by 12, and then you break it up into the months. So you do January through March, so that's 3 months. So times 3. So that's $1,000 of interest revenue. Sorry, I'm writing this on the wrong side. So $1,000 of interest revenue, which represents January through March. And then we also do the 333 number we got times 9 to get the rest of it from April through December. So basically that's the $4,000 of revenue just broken down. So I'll just write like that. And then in the cash disbursements / receipts area, we see that they got interest paid on it of $4,000. So basically that the interest they're paid decreases the receivable balance for $4,000. Which gives you the ending balance of, basically it just nets out, like, you add the 4,000 and then you subtract the 4,000. So a balance of 3,000 for ending interest receivable. So basically, the journal entries would be interest receivable, for 1,000, and then interest revenue, and then also the same thing. It would just be like, then it would be 3,000. Like, for this is January through March, and this is April through December. I'm just not going to write everything out, but then this represents the payment for the last year up till March 31st. So basically this $1,000 is getting written off through this, but you don't really need to know that for this problem. It just will eventually help you, like, if you can logic your way through it. And so basically they received cash, and so then interest receivable goes down by $4,000. So to me, this one probably is the hardest, but it also isn't that bad. Like, the thing that threw me off was I was focused on the March 31st date so much originally, but technically it's outstanding the whole year, so you recognize interest for the whole year. And then part D is going to be interest payable. Yeah. So interest payable is definitely the easiest one out of these four, in my opinion. So interest payable, let's see. The beginning balance is 0 for it. And so this one has a credit balance, which doesn't matter at the exact moment, but it's important to know which accounts do have debit and credit balances. So this applies to number 3. They borrowed a $100,000 note, 6%, and it was borrowed October 31st of the year the problem we're working in. So that means it's only 2 months of interest, which is really important to remember. So 100,000 times 6% gives you the annual interest rate annual interest amount. And then I divided that by 12, and then I multiplied by 2 to get it. So that is $1,000 of interest expense, which also increases interest payable. Basically, the entry would be interest expense, 1,000, and you increase the payable by the same amount because they incurred the expense, but they don't pay it until October 31st of the following year, I believe. Yeah. So then that is it for number 2. So I'll zoom out for a minute to let you see everything. So basically, we have prepaid insurance ending 2000, and then I didn't calculate ending for prepaid rent, but basically that would be 12,000 when you net it out. Okay, so then so A 2,000, B 12,000, C 3,000, and D 1,000. So hopefully working through the T accounts helps make the problem a little bit more clear. And then we're going to prepare the accrual basis income statement, which is number 1. And I'm going to start that on the next page. So basically the income statement is broken down when you do a multiple step income statement. Sales minus cost of goods sold equals gross profit. And then you have operating expenses and then other income and expenses. So interest is usually not an operating expense, so it goes in the other section. But everything else we had in this problem is operating. So I'll write everything out. Like, I like to write down this, like, to help me make sure I don't miss something too whenever I'm pulling the numbers. So there's salaries expense, insurance expense, rent expense, and then depreciation. And then that together, this would be operating expenses. And then operating income is basically gross profit minus operating expenses. And then we have plus or minus other income / expenses. So based on the problem, we'll add interest revenue and subtract the interest expense. So then this is how we'll get net income, which is the ultimate goal when preparing the income statement. So sales is basically, okay, it's going to be the cash receipts we got from customers. So this number is $675,000, but you also have to add in the change in accounts receivable, because that basically represents, like, when it increases, that's sales that were made on credit, and that's not included whenever you look at the cash received. So basically it would be 92,000 minus 62,000. So a change of 30,000. So that means sales are 30,000 more than cash receipts of 675,000. So that means that it would be 705,000 for sales. So that's basically, oops, that's a bad parenthesis, but cash received of 675,000 plus change in AR. Of 30,000. So that's how we got the 705,000. And then cost of goods sold, this is sometimes like a challenging account, because you have, in this problem, you have cash accounts payable for inventory, and then you have the inventory account. So like you have to make sure that you like read the problem and make sure that accounts payable is impacted, and in this problem it is. So we have, I like doing a T account, so I'm going to do a T account under the income statement. So the inventory T account is going to be like this, and we're given, sorry, a lot of scrolling, but we're given that inventory has a beginning balance of 80,000, ending at 62. So, and this has a debit balance because it's an asset. 80,000, so 62,000, and then we have accounts payable. So accounts payable, if we scroll back up, is going to be 110 is the beginning, 122 is the ending. So that's basically a $12,000 change. So 110,000 and 122,000. Oh, oops. 122,000. So basically, accounts payable increased by 122,000 minus 110,000, which should be, $12,000 change. So basically, that entry would have been inventory for 12,000 and accounts payable increases by 12,000 when it was made. So that's why it impacts the inventory account. So I take the 12,000 and I'll put it here because that represents part of purchases. But also, if you scroll up to the cash disbursements for inventory is 390,000. So that means that there were also purchases of 390,000. So basically, total purchases would be the 390,000 plus 12,000, so of 402,000. So cost of goods sold is like basically what the credit side of inventory is. Whenever inventory is sold, the entry is cost of goods sold, and you lower inventory. So that's how we're gonna find cost of goods sold now, is we have everything we need for the T account, and so you just have to solve. And so sometimes I like putting this in an algebraic equation. So basically it's 80,000 plus the 390,000 plus 12,000 minus X, because this is going to be a credit, equals the 62,000. So then you do 80,000 plus 390,000 plus 12,000. That gives you 482,000 in debits. And then if you subtract that from 62,000, okay, sorry, I typed that wrong. 62,000 minus 482,000 is 420,000. So basically you just have to, then if you didn't add the X and stuff, it's basically positive, but sorry if my work's messy now, but 420,000. So that represents cost of goods sold. 420,000. So 705,000 minus 420,000 gives us 285,000 of gross profit. Okay, and now for salaries expense, you will need a T account for this, or you need to just think your way through it. We're given that they paid 210,000 of salaries, and so we know that's part of it. So I'm just gonna write that here, 210K. But then we also have up here a salaries payable account that increased by 4,000. So the T account would be salaries payable of 20,000, and then ending will be 24,000. So that means that this increased by 4,000. And so the entry would have been salaries expense and credit salaries payable. This basically would have probably been a year-end entry where they incurred the salaries expense for the time that employees had worked, probably at year-end, and then they hadn't paid it out yet. So it's still an expense incurred in this year on the income statement. So you add the change in the account of 4,000 to this to get the expense of 214,000. And I'm just going to write every expense in parentheses because we're subtracting them from gross profit. So then insurance expense we calculated in the T account as basically it's the credit side of the entry, so it's 6,500. It's the 2,500 plus 4,000. And then rent expense, the same thing. We calculated that as 23,000. It's basically 11K plus 12K. So. And then depreciation is probably the easiest out of these. These ones are easy since we did the T accounts, right? But depreciation's sort of given to us if we look at the T account. We're given accumulated depreciation was beginning balance was 40,000 and ending balance was 50,000. So basically accumulated depreciation's a contra account. So that's why it's in parentheses. So it would have a credit balance. It's contra to equipment. But basically when it increased by 10K, that means that we incurred depreciation expense. So the entry would have been depreciation expense and accumulated depreciation. Sorry, my handwriting is getting worse the more I work through this, but that basically would have been the entry. Which, it doesn't ask for the entries, I just know sometimes it helps me to look at them. So then we're going to take our gross profit and subtract these. So minus the 214,000 minus the 6,500 minus 23,000 minus 10,000. So that gives us well, that gives us operating income of $31,500. The expenses, like, totaled up would be $214,000 plus $6,500 plus $23,000 plus $10,000. So total operating expenses would have been $253,500. So we basically subtract that total from there to get operating income. And then looking at other income and expenses, we'll basically use the T accounts we did too. So for interest revenue, it's basically this, which it's similar to, well, I think I did the entry down here. It's basically, this was revenue for the year, the 1,000 plus 3,000. So basically interest revenue will be 4,000, and that increases income. And so that's why I don't put parentheses around it. I'll put parentheses around that, although that's a subtotal, so I might like put it to the side a little bit too. Okay. And then, where was I? Oh yeah, interest expense is basically just 1,000 like we determined up here. And so let's subtract that. So basically the other income and expenses would just be 3,000 netted out. So 31,500 plus 3,000 gives you net income of 34,500. So that is the answer for part 1. Hopefully this video helps. I know sometimes it can be hard to explain it, especially not being in person and being able to ask questions. But I can always set up a Zoom call, or else you can email me questions and I can show like the journal entries or do more work to try to help you understand it. I think this problem's really good at understanding T accounts, and it's definitely a comprehensive problem. I feel like some of the hardest things were like inventorying accounts payable, and then also like the interest for me was difficult. But overall, like, this problem just takes time to understand. And like as you go through the course and stuff more, I feel like it will become easier and just doing the practice. But I think definitely knowing the journal entries and how to turn the journal entries into a T account is really helpful for this problem. And so I hope this helps, and have a great day. Bye!